welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We have this dynamic where the Fed is stepping in, cutting rates 50 basis point, obviously last week, but telling us that they will do more if required to prevent the economy from slowing down further. That backdrop is really great, especially for those investors looking to earn income in the fixed income market. So that is what we're highlighting in our fall outlook.
We think it's a correction from maybe too much pessimism that was happening over the past couple months. There are some analyst downgrades on the stock, some concerns of oversupply, cratering prices in the market. Really, we think these results ultimately showed that those concerns were unfounded, and we think the fundamentals are really strong.
Yes, the economy is shifting. Yes, there's some more vulnerabilities, but it's still an economy that is supporting the consumer. And by the way, has been for some time. One of the data points out this morning, the GDP revisions, I thought they were really meaningful. They showed upward revisions in GDP growth, upward revisions in consumer spending, and upward revisions in the savings rate. So the savings rate is higher than we had previously thought before the revisions.
We got 1 hour to go until the market closes. So let's take a look at the major averages here. Right now, the Dow is up at about 276 points. That's about 2/3 of 1%. I'm going to stretch it out a little bit here because we could potentially have a record close today. Kind of depends on where we end up. The same goes for the S&P 500, looking a little more likely on that end as we see a little bit of a gain in today's session here, up about 0.4 of 1%, and the Nasdaq up about 0.5 of 1%. Now, as you know, we got economic data today, jobless claims here falling, but we also got a bunch of GDP revisions. So we got GDP for last quarter, but we also got the last couple of years. The Bureau of Economic Analysis comes out and does this big sort of revision. And for the most part, the revisions were upward. There was a lot of economists talking about these numbers today.
Yeah, and also the decline in jobless claims was interesting,
Yeah.
Julie. I did see, different economist strategists, some who've, been on the show. I think if you think as rare and tricky as it is, those folks who believe Jay Powell has indeed stuck the soft landing, I saw them sort of using some of that data to kind of say, listen, this seems to be bolster our base case here.
Yes,
Yeah.
and then, so that's what's going on in the U.S. economically and with our central bank. And then, of course, there's the latest out of China, where we're getting more details on the stimulus plans that they are rolling out and considering rolling out. They're talking about injecting up to 1 trillion yuan of capital into their banks directly, their biggest state banks directly, as part of the stimulus plans that they've been talking about.
Yeah, rapid fire actions and measures. I mean, kind of question, what exactly is Beijing seeing in their economy to do that? I mean, obviously they're seeing a lot of softness, and so investors trying to, I think, figure out, okay, are these the right measures to really address the core reasons for that malaise? Fortunately, we have a very smart economist who's going to help us think through that.
Yes, well, in the meantime, if you take a look at China's stocks, I mean, the trade here in the U.S., lot of green on the screen. And just quickly want to look at the sectors in the S&P 500 because it's being seen here as well. The best performing group today is materials. Now, as we know, materials have been very sort of reactive to news out of China, economic news out of China. What is perhaps surprising today then is that oil is down, right? You would think because of some of the sentiment tied to demand out of China that oil would be up, but actually energy stocks under pressure, and that's because of a report out of the Financial Times that Saudi Arabia is pretty set on rolling off its production cuts. So in other words, expanding production. That seems to be hitting that group today.
All right, let's move on, get some more perspective on all this. For more on the latest market moves, the stocks near all-time highs here. Let's welcome in Michael Darda, Roth Capital Partners Chief Economist, Macro Strategist. Mike, it is always great to have you on the show. Maybe, Mike, we'll start with that economic data we got here today and that decline in jobless claims. Interesting to get your take on this, Mike, because I did see some economists, they saw that data, Mike, and they were telling their clients, listen, bottom line, the pace of layoffs is historically low. It's not accelerating. Take a deep breath. The labor market is not as weak, they were saying, as some economists are suggesting and perhaps fearing. Your response to that, Mike?
Absolutely. So thank you guys for having me on. The jobless claims data, I mean, if you just look at first-time claims, looks phenomenal, bulletproof, right? Very low levels recently have been pulling back. So if you look at first-time claims in isolation, it really doesn't look like there's anything wrong with this labor market whatsoever. Unfortunately, that is not the whole story. Earlier this week, we got a report out of the Conference Board that have some indicators that directly tie to the labor market that are also telling us something about September, and that data weakened pretty precipitously. A big decline in the present situations index and the labor market differential. They go out and ask people if they think jobs are plentiful or hard to get, and that differential correlates very closely with the unemployment rate, and pushed up to new highs for the year. And we also saw a bump in the August readings, so that would be consistent with the unemployment rate continuing to creep eventually towards 5%, and that would throw us back into the recession alarm bell camp if that ends up playing out. So unfortunately, we have mixed data points here. The GDP revisions that you both were talking about will look pretty good, but that's backward looking. Some of the more contemporaneous data, not first-time claims, that data still looks good, but we got data out of the Kansas City Fed and the Richmond Fed for manufacturing for September, missing expectations and looking pretty sloppy. So it's a bit of a mixed bag, but risk markets want to believe in the soft landing story, so we've been making new highs anyway.
Yeah, it's all about what markets believe, isn't it? Mike, I want to come back to what you were talking about the perception of jobs plentiful versus jobs hard to get. That's a number we were talking about as well from the Conference Board this week. And one investor we spoke to said, well, this is just the normalization process from the sort of very unbalanced job market that we saw during and then after the pandemic. How are you thinking about sort of what is a normal job market, what's a healthy job market, kind of sustainable at the same level?
Well, that's really an important part of the discussion here. The levels are still healthy in the sense that the unemployment rate is at a very low level historically, but it has been moving up in a persistent way. And when that happens, you have an economy that tends to be growing below trend or below the growth rate of potential. And it's very unlikely that that kind of a thing plays out and just sort of steadies at a level that we think is healthy and consistent with a soft landing. It doesn't mean it won't happen this time, but we're 0.8 of a percentage point off the trough on the unemployment rate, and we're still at a historically low level here in the low fours. But business cycles are about the direction, the rate of change, not just the level. So if you're coming off really low levels but inflecting upward, that still tells you something important about the business cycle and the threats to the business cycle. So we have a tremendous amount of optimism here with the major indices at record highs, that the soft landing is playing out, that it will continue to play out. I think a hard look at the data really leaves more questions there than answers, but obviously hope springs eternal. So we'll see what the next few jobs reports tell us. If we see the unemployment rate start to level off or even start to roll over again, that would be different. Typically, when you go up as much as we've gone up from the lows, you continue moving higher. And so the history hasn't totally been written here. So let's see what the next few data points bring us.
When you say, Mike, you talk about all the optimism in the market. So give me your take on valuation for the market, Mike. What do you make of it?
Well, we're pretty elevated here, back to a 22 forward multiple on the S&P 500. It's almost like 2022 didn't happen in a lot of ways, Josh. So, that year we had 2 down quarters of GDP in the first half. One of those quarters was just revised away, and a 25% fall in the S&P 500 in the first 10 months of the year. And you had a lot of people thinking we were in recession. And although I've been a more cautious voice, that was not our view back then. Our view was if the unemployment rate is falling, there's no recession going on, period. 2 down quarters or not in terms of GDP. Well, what's happened here? We have the S&P 500 back up essentially to its peak multiple that we saw in late 21, early 2022. We've only had 6+% earnings growth in the last 2 years and a 60% rise in the S&P 500. So So this move higher over the last 2 years is essentially valuation driven, and we've reset to where we were in late 21, early 22. But that was a period where we had peak liquidity levels, very low long-term interest rates, far lower than they are today, even though they've been moving down. So I feel like there's a bit more vulnerability here in terms of risk markets, but that's been my belief, and we just keep melting up. So it's when you have these momentum-driven valuation expansions, it's really hard to step in front of them without getting run over.
Well, and Mike, what's been interesting as well, because I think you can say that's happened in the overall market and it's happened in the Gen AI trade in particular, right? We've seen that. But there's been this sort of very much up and down move there, right? Where the stocks run up towards records and then they pull back. And they haven't reattained those records. And they keep having that sort of up and down. They're in an up cycle, it seems, once again. We're going to talk to somebody a little bit later who's behind that Bain & Company report on the spending that's expected for AI. But I'm curious how you're thinking about the fundamentals versus the stock action in that particular group.
Yeah, great question, Julie. So for the Infotech Index, we've doubled. The S&P 500 Infotech Index has doubled over the last 24 months, and earnings have been better than the overall S&P, but they're up about 20%. So there's been a huge valuation expansion there as well. A lot of excitement and optimism over AI and the spend out that's going on. Look, I don't doubt that what's going on here is revolutionary, but I also think there's quite a bit of hype. And if you look at these periods of innovation in the past, they always are associated with what look like, bubbles or mini bubbles, if you want to use that word. We could just say valuations going to high levels and then, eventually consolidating and retreating. Typically, what you don't see is just a leveling off at historically high or record valuation levels and going sideways for an indefinite period. Typically, things start to tip over a bit, and that could be happening with some of these stocks that have been leading the S&P 500. 5 or 6 names in 2 sectors now account for 40% of the market cap. And as you noted, there's been in recent weeks a bit more of a struggle there. So it is a healthy thing to see some of the other sectors do a little bit better here, but I think the business cycle dynamics still are important. We've liked the more defensive areas, so I'm happy to report that the utilities are the number 2 sector year to date, just a hair behind tech. So we recommended the utilities last October when the 10-year pushed to 5%, and they were really having a tough time back then. So probably not a great entry point here, but we would still stick with a mix of defensive, and I'd be careful on the more cyclical areas. But if we're going to add risk, I would say probably what looks like the underperforming value areas of the S&P 500, as long as we can go slow and be really patient there, because there could still be some business cycle risk.
Right. Well, you have indeed been right on those utility stocks, Mike. Good to see you. Thanks for being here.
Great to see you too.
Well, Michael Darda was just talking about some of these high flyers coming down. One of them is Supermicro Computer. Those shares are plunging by almost 12%. And this is related to a report from the Wall Street Journal, which said the Department of Justice is investigating the server maker for alleged accounting irregularities. Now, Supermicro's trading was briefly halted following the news earlier. It's now down, as you can see, that big decline that we are seeing on the day. This sort of originated in a report from Hindenburg Research, the short-selling firm, which came out with a report in late August and effectively said there were some accounting irregularities. It was based on some stuff that a whistleblower had come out with. And now it seems as though this has all caught the attention of the Justice Department.
Exactly right. That's what the Journal is reporting here, that a prosecutor at the U.S. Attorney's Office in San Francisco asked for information, the Journal is saying, that appears to be connected to a former employee who, as you mentioned, Julie, accused the company of accounting violations. That former employee filed a whistleblower lawsuit. And as you know, and we talked about this last month, short seller Hindenburg published that report about Supermicro and did place bets against the stock, relied on part on that former employee's allegations. This is a name that a lot of investors piled into as they thought a smart way to sort of leverage that mega AI trend. At this point, listen, still up strongly this year, but you are now down about 70% here from your intraday high.
Exactly. And, this company did pay $17.5 million back in 2020 to settle some Securities and Exchange Commission claims that there were some accounting violations. Now, the whistleblower, the former employee there, says they fired some people. Supermicro fired some people related to that, but then rehired them. That is part of his allegation. So we'll bring folks any more developments that we get on this. But this is, of course, one of these AI-related darlings that we have been watching closely. We're just getting started here on Market Domination. Coming up, chip stocks jumping today on the back of Micron's strong guidance. We'll check in on the sector later in the hour. Plus, the average rate on a 30-year fixed-rate mortgage has reached its lowest level in 2 years. Is that indeed good news for the housing market? We'll discuss all that and more when Market Domination returns.
Chip stocks are roaring today, led by Micron and its strong guidance. We broke the report when it crossed, Julia. Obviously, there was a lot of focus on Micron, and for good reason. Big memory chip maker. Certainly another way investors have tried to play the AI theme. That was a solid quarter. I mean, they beat street expectations. for both the reported quarter as well as the guide for the November quarter. Key there too, as we talked about when the report crossed, HBM, key focus for investors, high bandwidth memory, super fast memory, capacity for 2024 and 2025. We were told it's sold out and investors piled in.
Yeah, most definitely. And also the company making some comments that it expects PCs and smartphones, devices to sort of pick up here. So that seems to be one of the things that's creating this ripple effect as well. I'm just looking at some commentary from Timothy Arcuri over at UBS, who is positive on Micron. And he says Micron continues to establish technology leadership and management in maintaining its constructive supply-demand outlook through next year, and talks about durability, that HBM demand. So that's one of the things people are really focusing on, that high bandwidth memory that you mentioned. On the flip side, Vivek Arya over at Bank of America says that those sales of high bandwidth memory do remain exposed to what he calls the lumpiness of product cycles at just a handful of customers. And he said, there is a potential other vendor, which is Samsung. So that's something to keep in mind on as well. But I think that's a really interesting point about there are not that many players. They are very large. And so presumably, if one of them said, we're going to cut back a little bit, that could have an outsized effect.
Yeah, I should look at the SMH too, Juliana.
Yes.
So the ETF that tracks the chips. I mean, still very strong this year. You dropped a pretty meaningfully from that record closing high we saw this summer. All kinds of reasons for that. I mean, some of that could be, just investors rotating out of winners, but different story today. Obviously, nice pop.
Yeah, that's down about 10, 11% from that record high back in July. Well, the chip sector in general has been getting a boost this week. It's in part Micron. It's in part a new report from Bain & Company, which highlights that the market for AI products and services could hit up to $990 billion by 2027. To talk more about that is David Crawford. He's Bain & Company Global Technology Cloud Services Practice Chairman and one of the authors of that report that got so much attention this week. So David, thank you so much for being here.
Happy to be here. Thanks for having me.
So as you know, there has been an enormous amount of attention on this Gen AI wave, and presumably that's why you guys decided to dig a little bit more deeply into it. I'm curious, as you look at that up to 55% annual demand increase through 2027, where you see that coming from specifically, how that's going to sort of play out, and also how it's going to change over time.
Yeah, great question. I think we see three kind of broad pockets of growth. One is at the halo end, at the high end of the market, where the large hyperscalers are racing to kind of build out the best capabilities. That's generating an enormous amount of demand that works its way back through the supply chain and creates just shortages in a spectrum of spaces. The second is enterprise adoption, where we know the trends are smaller models, more specialized models, open source, et cetera, but likewise requires computational capability. In some cases, they're using special purpose compute and so forth. That's the second big pocket. And then the third is the independent software vendors themselves building these capabilities directly into their products and running them in their own data centers. So between the three, there's just actually a lot of demand, and those three will interact over the coming years as well.
Do you see AI as being sort of fragmented looking ahead, David, globally? Meaning, is it going to be developed and deployed very differently depending on the countries, geographies?
Yeah, an important question. We think relative to, say, something like a cloud disruption or big data, there will be more interest in sovereign ownership, sovereign control, sovereign domiciled data centers and so forth, because it's broadly perceived that AI will be quite different in that it'll control culture, access to health and welfare, things like that. And so we think that the sort of state interests will play a much bigger role in the ultimate location of where all this occurs.
I was also struck by some of your research in this report on the size of different enterprises and what they're spending and how much that spending has changed over the past year. And, the bulk of enterprises out there are on the smaller side, so they are spending less as a function of their size. But are they going to be left behind? Are they spending enough? How are you thinking about that?
Yeah, we'll see as time tells. But yeah, we were astonished to see the rate at which, for example, in the report we published, the number of companies is spending over $100 million in their annual IT budget alone on AI. And with large enterprises, that's doubled. but it's not confined specifically to large enterprises. Smaller enterprises, whatever level they are spending at, has actually doubled as well. And so you can pick any kind of spend or IT budget threshold, and they're almost uniformly increasing their spend.
David, one theme that often comes up when you talk about AI, where it is and where it's headed is the potential impact on labor markets, how it could upend, redefine labor markets. There's already been some really interesting reporting done about the impact it's already having, for example, on call centers. As someone who thinks, a lot about the technology, how do you think through that dynamic?
Yeah, I definitely think it has it presents opportunities for people to be more productive, and therefore they can do additional things or do more things or do different things. How that ultimately shakes out as jobs impact, to me, I'm an optimist. I've been around the Valley long enough to have seen a few of these technical disruptions, and almost every one had predictions of doomsday. I actually think it allows people to find new and higher value activities, but there'll be dislocations along the way.
Well, let's also talk about the dislocations at the strategic level for software companies specifically, because that's one of the, from our perspective, since we watch markets so closely, software stocks have really been sort of through a tumultuous period as people try to figure out what this means for them specifically. And you write about that in the report as well, that they have some particular challenges. What do you think is the biggest, and how are they doing so far with meeting that challenge?
Yeah, I mean, there's no shortage of kind of pundit opinions about the end of software, or the Armageddon's ahead, or the apocalypse is ahead, and so forth. We actually think this is actually a pretty big opportunity for a lot of the software companies as well as a threat. The capacity to accelerate your software development pace for both software companies themselves and for enterprises who are doing some level of software coding internally is extraordinary. And as we've got into it with our clients, we've found that it's not just a technology deployment. You could give out a Copilot or a coding assistant program to all of your employees, and it could have almost no value whatsoever. To get it right, you really have to dig in, go through your business processes. In other words, to get value out of this, you have to have people doing their work in a different way. And so that requires business diagnostic, change programs, all the things that you have to do to sort of get value out of it. It's not like cloud where you can just deploy the technology and get value.
David, big, important topic. Thank you so much for helping us think through it.
Happy to talk to you anytime.
And coming up, the 30-year fixed-rate mortgage trended down to its lowest level in 2 years. So what's that mean for the housing market? We're going to discuss when market domination returns. The 30-year fixed-rate mortgage trending down to its lowest level in 2 years. And here with more is Yahoo Finance's very own Claire Boston. Claire.
Hello. Yes, so we had mortgage rates, they just dropped a tiny little bit, 1 basis point, but that was good enough for the lowest level in 2 years. We're at 6.08%. Every little tiny leg down is an improvement in affordability, which is something that we really need right now in this market.
So what are you hearing from here? I mean, because we've talked a lot with you, with other folks, about kind of how quickly the cuts will then feed through. So this seems like good news. It seems quick. But is it going to continue to work like that?
Yeah, generally speaking, pretty much all of the Fed action that we saw is already priced in. The Fed is expected to cut a few more times, but that doesn't mean that mortgage rates are necessarily going to go down 25 basis points each time. A lot of people I talk to are saying this kind of six-ish space is where we will be, for a little while. And then maybe as we head into spring and next year, we could get down a little lower into the fives, maybe 5.5.
Let's go 5.5.
Yeah, that's what you need to refi.
That makes sense. Let me ask you, the drop we've seen already, has that already spurred some meaningful demand?
What we are seeing is that there is an interest in refinancings. We had a really big uptick in the refinancing index earlier this week, up 20%. So that means that if you've got that mortgage that's over 7%, you may be in the money to refinance now. And so we're expecting to see more of that for those people who kind of bought at the very top of rates.
Yeah, I was complaining about 6.5, 7. Yikes.
There's always somebody who's got it worse than you.
Very true.
Right, Claire,
very true.
Thank you. Appreciate it. Well, with mortgage rates now at those fresh 2-year lows, the hope is that the housing market will start opening up. Our next guest says falling rates alone are not a magic bullet. Joining us to talk about that and much more going on the economic front right now, Lauren Seidel-Baker, ITR economics economist. Thank you so much for being here, Lauren. So I want to start with rates and then get to, economic data, the strike, et cetera. But let's start with rates here. So how much of a spur, a stimulus, is that going to be to see rates get down to where they are right now?
So to see rates get where they are right now, that will help. But as you said, that is not going to solve our housing problem. We have been essentially underbuilding homes in this country for more than a decade now. New home starts have not kept pace with household formation. So there is a lot of demand. And the big pressure in housing is affordability. We have higher prices, some cooling off in the most recent time period. Again, we saw a real spike immediately post-pandemic. So prices are much higher. Interest rates are much higher. They're not going back to those near zero levels. So we're not getting back into those 2, 3, 4% mortgage rates range, at least in the near term. That means affordability is still a challenge, and that's going to suppress new construction activity. I just don't see a quick fix solution for this housing problem.
Did you like, Lauren, though, speaking of that? I mean, obviously an election year, politicians, are aware this is an issue for a lot of Americans. Kamala Harris talking about 3 million more units. Does that make sense to you as a part of a broader policy prescription?
Policy, it's very hard to say that a policy prescription can fix a market that is imbalanced. Again, all real estate is very much local, so we see population flows moving across the country. Really, some markets are very hot. Other ones feel a little bit more imbalanced. So I don't think any one policy could just fix this across the country. We will, however, see that ongoing strength in the consumer. Our wages are rising at a faster pace than inflation, so our real purchasing power is still improving. That means that with these affordability constraints, our general consumer is still in somewhat of a position to weather this affordability hit. Again, it's going to remain a challenge, but it is not showing that the bottom should be dropping out from this market, for example.
So obviously we're talking a lot about the prices that people are paying and the rates they're paying on their largest purchases, their homes. But I want to switch gears and talk about the prices they may be paying on things that they're buying every day, say bananas, for example, because we've been watching this port strike, which may be happening as of October 1st, and we've been trying to figure out how it's going to play out and the effect it's going to have on prices, at least in the short term. How are you thinking about it?
the big effect will be pricing. That's where we find balance in any market. So I've heard a lot of different theories, right? There are some assumptions being made in terms of the scale if this strike does in fact take effect. On the upper end, this could be as bad or even worse than those initial supply chain disruptions of the pandemic. Now, the good news is a lot of businesses learned during the pandemic supply chain issues how to get around things, how to be more flexible. In the recent, I can't believe it's now over 4 years since the pandemic struck, but in that term, many businesses diversified their sourcing. So this would affect a lot of ports. It clearly would be a challenge, but we've also seen supply chain issues pop up from the Panama Canal with the drought, from the Middle East with geopolitical tensions going on. So this is an increasing problem, but also that is increasing awareness for a lot of businesses. We are seeing that diversification. Bananas are a funny example. Fruit and vegetable prices actually have risen at a much slower pace than a lot of other groceries. So we could say something like bread prices up 30% from late 2020. Maybe those would be much more strain on consumers' budgets. But again, we do expect that the immediate impact would be inflationary. Hopefully this strike is averted.
So is your point, kind of line of sight there with our supply chain, Lauren, as you noted, I mean, obviously upended during COVID. The supply chains have bounced back, though, generally. They look healthy, they look resilient.
They do. And in a lot of ways, we've had to forge new links in that supply chain. So much foreign direct investment coming to the United States, so much more re-onshoring or near sourcing. There really is an ongoing push. I think it existed before the pandemic, but was really accelerated, really amped up during the pandemic. So many businesses are just looking for new nodes in that supply chain to do all of this here in a way that we hadn't been, say, a decade ago. We've seen shipping costs coming down. We do see much more resiliency now. And again, I think it's that general awareness that we need to be a little bit more flexible. We need to have redundancy or flexibility, as I said, diversification in our supply chain built in. Businesses are starting to plan for those contingencies in a way that I just don't think we did pre-pandemic.
Lauren, great to have you on the show today. Thanks so much for joining us.
Thank you.
All right, let's get to some calls of the day sponsored by Tasty Trade. Deutsche Bank raising its price target on Nike from 92 to 95, the note highlighting the company's CEO transition. But that's not all, Julie. Deutsche Bank, they like this name. It's a buy. They say Nike is poised for a turnaround. They tell their clients, we think Q1 results will be broadly in line. Q2 guidance will likely bracket the street. As a result, they say we anticipate Nike will reiterate its full year guidance.
Yeah, but they're looking for some specifics on the call from Nike too when it reports on Tuesday after the close of trading here. First of all, they're going to be looking for the new product pipeline and key milestones, they say. Secondly, the wholesale order book outlook, commentary on China. Thirdly, the margin outlook because of the promotional environment and rising freight costs and inventory positioning. And of course, remember, tying it back to the discussion we were just having, this is going to come on the same day that there might be a port strike being announced. So perhaps when we speak to all of the inventory and pricing, et cetera, freight costs, maybe there'll be some questions about that as well.
They also do talk about changes in the C-suite, of course.
Sure.
Elliott Hill taking over as CEO, says they think he's a good fit for the role. They told clients, talked about his experience at the company, seasoned veteran, thinks he's going to focus on product innovation, marketing, and rebuilding those wholesale partnerships.
Yes. All right, let's also talk about a call for a big bank. Barclays upgrading New York Community Bank from equal weight to overweight. The note citing the bank completing the heavy lifting around credit evaluation here. And the analyst here, Jared Shaw, saying that it's added multiple new leaders, including a CEO, CFO, and chief risk officer, raised capital, so that it is just sort of on a better footing than it was previously.
Well, we talked about this name a lot earlier this year, and of course, your stock got nailed after they flagged real estate risks. Investors got spooked. Then a few months later, we had changes in the C-suite there. The stock has been under real pressure. I mean, it's still down about 60% this year. Most on the street on the sidelines. They have a hold, but Barclays clearly a believer, improving fundamentals, better times ahead.
Yeah, the stock is still, down 63% this year.
Rough.
So, yes, it is.
All right, coming up, China stocks jumping after some of the country's top political leaders said they are pledging to shore up the country's economy. We're going to check in on some of the top trending tickers when market domination returns.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Shares of China stocks jumping again today after some of the country's top political leaders said they're pledging to shore up the country's economy. The likes of Alibaba, JD.com, PDD, they're all soaring in today's session. And the latest is that China is talking about injecting capital directly into its state banks so then they can help support the economy. That's according to reporting from Bloomberg here. And what I found interesting, Josh, is not only are we seeing those U.S. listed shares of Chinese companies rise, basically anything that does business with China. So we're seeing metals and mining stocks rally, Albemarle rallying today. Estee Lauder caught my eye as one of the best performers in the S&P 500 today. And then the casino stocks, which of course still have big business in Macau. So if Chinese consumers have more money to gamble with, that could be good news for them as well.
Yeah, so Beijing making big moves here to stabilize this economy, and you see initial positive reaction. It'll be interesting to see what the follow-through is like.
Yes.
Is this really the answer and the solution to the problems there? There was another wrinkle I thought was interesting. I saw some strategists / economists asking, okay, so let's say it does work. Does that change or impact, they were asking, the disinflation story that central bankers have been telling? Does that change that? Does that introduce a more, if it did work, if they were successful, would that introduce more inflation volatility?
Very good question.
That was a very good question
I don't
by
have
some
the
smart
answer.
people.
Yeah.
I believe that was Peter Bugfar. I think that's.
Yeah.
Just give Peter credit.
Yes.
All right, shares of Southwest Airlines rallying after raising its revenue per available seat mile guidance. The airliner also announced a $2.5 billion stock buyback program. So a bunch of news, actually, Julie, for their investors today. We had capital return news, $2.5 billion share repurchase program. Had some forecast news. Looks like they did a raised third quarter sales forecast, and even some board changes too. Added former airline executive Robert Fornero to the board. All coming, by the way, of course, as we have the fight with Elliott.
Yeah, and Elliott's out with a statement saying we're not backing off.
No,
we're still
not
gonna
at all. Right.
we're still gonna be pushing for changes here. They say in a statement today, we remain determined to call a special meeting at which shareholders' voices can be heard. We encourage our fellow shareholders to call back their shares and prepared to elect an independent board of directors.
Yeah, I saw CEO Bob Jordan quoted in a report saying details by Southwest have been in the works for a long period of time.
Longer, they say, right?
For Elliott to call that plan rushed and haphazard, in my opinion, is inane, he said.
The fight continues.
No olive branch offered there.
Yeah. Let's also talk about Wells Fargo, because those shares have been rising today after the bank reportedly sent the Federal Reserve a third-party review of its risk and control overhauls. This comes as Wells Fargo looks to shed an asset cap that was imposed by the Fed. In other words, it could only grow so much. That was a rule imposed at the end of Janet Yellen's tenure as Fed chairman back in 2018, early 2018. The shares are up 5% today, but Wells Fargo has really trailed the other banks as a result of these, at least in part, as a result of not being able to grow more.
Yeah, Bloomberg, who has this report citing, they say, sources, I kind of think puts that in perspective, Julie.
Yeah.
Shares are still trading, below where they were when this measure was actually put in place. And during that cap's lifespan, they point out, JP Morgan has swelled about 60% to more than $4 trillion of assets. In other words, they say Jamie Dimon has basically added nearly an entire Wells Fargo to his balance sheet.
Yes, that was a good factoid, I thought. And even though the shares are rising today, the report cautions that the cap, even if they're preparing
it's a road ahead.
Right,
for sure,
exactly. Yeah. It's not going to happen instantly, but it seems like that they are making the steps necessary to get there.
Yep. Keep watching. All right, moving on. These streaming wars are entering a new phase now. Cord cutting is accelerating. The fight for sports media rights has never been more competitive, and the hunt for advertising dollars is nonstop. With just a few minutes left till the closing bell on Wall Street, we're looking at how to play streaming stocks with the Yahoo Finance Playbook. And joining us now is Tim Nolan, Macquarie U.S. Equity Research Senior Media Tech Analyst. Tim, it is good to see you. You published some recent research on Disney. I want to start with that name, Tim, and maybe start at a high level. You remain neutral on Disney, Tim. I'm interested why that is and what it would take for you to get more bullish on Disney. Going ahead.
Sure. Thanks for having me back. The report we published recently tries to model out a lot of the moving parts that are going to hit Disney's P&L, balance sheet, and cash flows over the next couple of years. This includes some incremental sports rights from the NBA rights renewal, college football expansion, some of the India business coming off of the P&L probably next quarter. But primarily, it's about the launch of the ESPN direct-to-consumer service. So in August 2025, ESPN plans to launch a service that you can get without having your pay TV. And this is the same ESPN that you get on pay TV. So this is, in my opinion, the largest event in the streaming landscape, well, at least since Disney Plus launched 5 years ago, and perhaps even bigger than that, because if there's one thing that's keeping consumers on pay TV, it's sports. a lot of sports is now available on streaming services, and ESPN is the largest streaming service. So ESPN going completely over the top, direct to consumer, I think is a very, very meaningful event for the pay TV landscape. The pay TV network groups, Disney, Fox, Warner Brothers Discovery, et cetera, are painting these moves as, adding incremental subscribers that don't have pay TV. We think, though, that by putting ESPN over the top, there's a very likely chance that cord cutting will accelerate. By our calculations, cord cutting means about 8.5% of consumers are dropping pay TV every year. And that includes some of the virtual ad backs like Hulu Live or YouTube TV. 8.5% is probably going to, go to maybe like 15 or so percent once ESPN direct to consumer hits the market over the subsequent quarters. So the big question is, can Disney offset that decline with new ESPN direct to consumer additions? So our work tries to figure out how this is going to pan out. We are neutral on Disney stock, basically until we get a better sense of how that's going to look. It could be a good year and a half until we really, really know what the pace of cord cutting is going to look like and how successful ESPN direct to consumer is.
Well, and Tim, just to put a fine point on it here, is it a one-to-one? In other words, is a cable customer worth the same to Disney as an ESPN over-the-top customer?
Right. That's the big question, I guess. And it's difficult to know really how you're supposed to do the math, and even actually what the definitions are. We've got, for example, Disney with Charter, as well as Warner Brothers Discovery with Charter, and Paramount with Charter have these hybrid distribution agreements where you get your pay TV as a consumer, and you'll also get ad-supported streaming services as part of that package. So what do you count a consumer as? What is a household of pay TV or a streaming household? So that's a bit of semantics, but as you're releasing these direct-to-consumer services through alternative platforms, or even as you're launching these services, you're probably doing them at lower price than you're going to get from the actual retail, 1-year-long customer. So, what's the wholesale price that you're going to get for those via the traditional distributors versus what is the actual price you're going to get for a fully paid subscriber? And look, we really don't know. We really don't know what is going to happen to consumer adoption of these services and who's going to be dropping pay TV and adding more of these streaming services. I think the train has left the station a long time ago, and I think consumers are looking to streaming as really their primary means of gaining TV. Now with so much sports available on streaming, I mean, think about it. The new NBA rights deal, a third of that is on Amazon Prime. The other carrier is NBCU, which is going to have all those games on Peacock. Right. And so a lot of NFL games are available on streaming services now. So I think consumers are coming to expect this to be the case. And so, yes, to your question, the real upside potential for these network groups like Disney running ESPN direct to consumer will be, can they actually add customers that have already cut the cord? That's where the longer term big question mark for the upside is. So right. we know you're losing pay TV. We know cord cutting is accelerating. How much will accelerate? Will you replace one for one? But even more importantly, over time, will you actually add households that do not have pay TV services right now? We don't know.
So right now, you've got that neutral rating on Disney. It's my understanding you do have a buy on Fox, and I'm just curious why you think they're in a better position. Do you think among the streamers and networks here, are they in the best position in your view?
Correction, actually, sorry. No, we do not have a buy on Fox. We have a neutral on Fox as well. We do have a buy on Netflix, which we think is, the clear winner in the streaming wars. But we are neutral on Fox. I have to give Fox credit, though. We're surprised it's done as well as it has because it does not have a streaming service, and they've been dependent on the pay TV bundle much more than the other companies have. The funny irony of this is they've done well. Well, news and sports are keeping people on the bundle. Fox has done reasonably well because they have not launched a streaming service that's cost them a whole lot of money, like Disney Plus and Max and all these other services have done. So hats off to Fox for getting this far. I do question, though, what the future will look like if cord cutting accelerates even further, which we think it will, and they are reliant on that pay TV bundle.
Tim, I'm just curious, when you talk to clients about Disney, how much is the subject of Bob Iger come up, and specifically succession issues at Disney? Is that something they ask about? Mm-hmm. And if they do, what do you tell them?
It certainly does come up, yes. Evidently, we have 2 years to go in his tenure, end of 26, if I'm remembering correctly. Yes, just given all of the corporate change and turmoil at Disney over the years, and many years of questioning when Bob Iger will be stepping down and what happens next. Yes, it is a top of mind question for investors. I certainly don't have a call. I don't know what's going to happen. But you have to say Bob Iger's done an excellent job while he's been at Disney, at the head of Disney. But yes, this is clearly a big question for investors. Now, if he goes for the remaining 2 years of his contract, if I think I have that right, 2 years from now would be 1 year plus into the NBA rights deal starting, ESPN Direct to Consumer having launched. So maybe by that time, Disney is in a more stable spot, and it might be a good time for him to step down.
And finally, I want to ask you a question about Warner Brothers Discovery, because I was intrigued yesterday to see the headline that John Malone was defending, well, maybe not surprised. He was defending his friend David Zaslav, who is the head of Warner Brothers Discovery, at a time when the stock has not done well, but he talked about its bulletproof balance sheet, and he praised Zaslav in particular. Do you think that Warner Brothers has sort of been unjustifiably unloved? Or do you think justifiably so?
Justifiably, I think. If they've been perhaps punished more than others because of their heavy reliance on pay TV, which is ironic because, they've had some pretty strong brands with some pretty strong global presence. I'm talking HBO and Discovery. The Warner Brothers studio, I think, has global brand recognition, a very, very deep and broad franchise. And the Max service, which now combines HBO with, the Discovery and Scripps content, is broad. They are expanding now internationally, so there is upside potential. But I think the reason that stock has suffered so much is they have amongst the highest, if not the highest, contribution to their P&L from the traditional pay TV universe outside of Fox. They do have high debt, and they've just moved through this very complex acquisition, between Discovery and Warner Media, and so it's taken time. They've had to cut guidance several times, and there are a lot of open questions as to how this company will do. We're neutral on this one as well. They lost the NBA rights, which is, I think, difficult situation for them to be in. So I don't know. It's a tough one.
All right, Tim, listen, we appreciate your time in those picks. Thank you so much.
Thank you.
While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains, where for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. Let's see where the major averages ended the session here today. We've got the Dow trading higher by 260 points. That's 0.6%. It looks like the S&P 500 did close at a record today, I believe. Yes, it looks that way. Up about 0.5% over the past few days here, and on the day up about 0.4%, and the Nasdaq up 0.6%. As we talked about, jobless claims coming in lower than estimated, and that bolstering some hopes that perhaps the Federal Reserve has achieved its soft landing without pushing up unemployment. But there are some skeptics, of course, to that view, including among them Mike Darda, who we talked to at the top of the show. Interesting also today to once again see the equal weight pushing higher and exceeding the gains in the S&P 500, showing once again, it wasn't this way yesterday, but showing the broadening of the rally that we have been watching here. If we look at the groups that are on the move here today, we talked about China stimulus also giving a boost to some groups, including materials. That's the XLB. Tech up 1.29%, communication services. Energy lagging along with real estate and utilities today as we see sort of a cyclical rotation to some degree going on in the markets. And if we look at the Nasdaq 100 here and what's on the move, pretty mixed here if you look at the largest of the large caps, the so-called Magnificent Seven. Otherwise, if you equal weight it, you do see more green on the screen here. Some of these are indeed some of those China-dependent names or China companies themselves that are listed here in the U.S., some of them related to the ripple effect that had to do with Micron here today. Micron reporting those numbers that beat estimates and also raising its forecast, and so we're coming out with a forecast that was above estimates, so up 15%, and almost all green on the semi screen, with the exception of Supermicro Computer, which, as the Wall Street Journal reported today, is under investigation by the Justice Department. Josh?
All right, thank you, Julie. For more on today's action and the markets moving forward, we want to welcome in now Sebastian Page, T. Rowe Price, Global Head of Multi-Asset and Chief Investment Officer. Sebastian, always great to see you on set. Let's start here, Sebastian. You say you are very close to neutral on stocks versus bonds, small overweight to stocks, you say. Let's start there. Explain that positioning for us, Sebastian.
Well, Josh, one thing I've learned doing media recently is that a short explanation is best. So let me try to give you...
We've got some time, Sebastian.
We got time? Okay.
Oh, yeah.
Let me try to give you the bull case in 2 words and the bear case in 2 words. And that'll highlight why we end up neutral. The bull case in 2 words, 4 words. Bear with me. Earnings up, rates down. That's pretty good for stock markets.
Yeah.
Okay, what's the bear case?
I think you're going to tell me something to do with it being priced in.
Yes.
Yeah.
Economy down, valuations very high. So I don't expect a recession over the next 12 months, but to your point, Josh, it looks priced in. So we end up at neutral. There are opportunities under the hood, but that's where we are right now.
It feels like we're in sort of this so-called melt-up period, right? And what was so fascinating is going to September, there was all this hand-wringing about how terrible September is.
Yeah.
September's been fine. It's been okay. So what does that then mean about where we go from here?
Yeah, you know, we just had an asset allocation committee, and some members of my committee are talking about a little bit of exuberance and or complacency maybe.
I was going to say, it doesn't feel too exuberant.
Yeah, like let me play devil's advocate on the idea that markets are super expensive, right? It's barbelled between some stocks that are trading really highly valued and others that are reasonably priced. Here's an interesting stat for you. The average stock in the world has a price-earnings ratio on the forward 12-month earnings of 13. That happens to be the long-run average. So if you go beyond U.S. large cap stocks and you look at small caps, emerging markets, and you broaden the portfolio and you look at an equal weighted index, you end up with essentially average valuations. So this speaks to the market broadening potential.
Okay, so the overall the market may look pretty elevated. When you look under the hood, are there certain sectors, Sebastian, you would say, hey, that actually looks attractively valued still?
Yeah, look, we like value stocks in general. They've quietly outperformed growth stocks by 10% since mid-July. And we like industrials, we like healthcare. Financials are doing better with the steepening of the yield curve. And on energy, this is a sector that's been lagging. But if you look at the history of commodities, they kind of go through cycles, and it's starting to feel like we might be a little bit at the bottom of the cycle. And also the election could be a catalyst for value to outperform. So it's not a very large overweight, but we're positioned for broadening towards value more than towards small cap, where we're more neutral.
And then you mentioned you're taking the global view also. So where else, I mean, we're so U.S. focused, but where should investors be looking outside of the U.S.?
You know, there's some countries that are struggling. There's some fresh stimulus in China.
Sure.
But this is sort of against a pretty tough property market environment, unemployment, a cratering of foreign investment. Germany's struggling. But we do like Japan still. We do like emerging markets ex-China. And so there are opportunities outside the U.S. as well.
That's interesting about Sebastian, because obviously, listen, it's been a big theme this week is Beijing moving in and with these rapid fire actions and measures. And that is, I mean, as investors, you're trying to figure out, okay, will it work? Is that the right kind of medicine for the problem? It sounds like maybe you would rather have a wait and see approach.
Look, it's definitely positive, and you've seen markets react. But you're in a middle of a big structural change with investing in China, and it might not be enough to turn it on a dime, right? So, yeah, I would say wait and see for us right now.
Okay.
Also, I want you to ask him the question you had earlier about inflation in China or disinflation in China.
It's not really my question. I'll take
question.
it. It's actually Peter Butfar's question. Yeah, he did raise I thought it was a really, and Peter writes a great note every morning. It was a good, interesting question I'll pose to you, which he was asking, let's say in China, let's say it actually works. Let's say they're actually successful. He was asking his clients whether the disinflation story that a lot of central bankers are asking, would that have to be questioned here? Would that actually introduce some inflation volatility?
It's a valid question. You need to see the demand and the growth coming out of China. Like, it's not like we're going to see, in my mind, a big property boom and huge spending in materials and commodities in general. So again, I take a cautious approach to that. But generally on inflation, the base case is that it's coming down, but it could come back up or be stickier than expected. It's kind of hard to predict these days. The shelter component, commodities might be at a bottom. Demand for services is pretty high. The labor market is not maybe as gloom and doom as people think if you look at claims this week. So, you know, there's a risk there on inflation. It might include China on the margin, but it's a broader risk.
And it's one that the market seems to have discounted.
Completely.
Yeah.
I mean, the swaps, the inflation swaps on 1 year are like a 2% flat.
Right.
That's what people are trading on.
You always have to be prepared for that surprise. Sebastian, good to see you. Thanks
Likewise.
for coming in. I appreciate it.
Thank you.
Well, coming up, Costco is set to report the latest earnings. We'll get you those numbers when Market Domination Overtime returns. At the intersection of politics and business sits David Rubenstein. He's the co-founder and co-chairman of the board of Carlyle. He is the relatively recent owner of the Baltimore Orioles, host of the David Rubenstein Show, and he's also the author of a new book, his fifth, The Highest Calling, Conversations on the American Presidency. David, thank you so much for joining us.
My pleasure. Thank you for having me.
You know, as I read through this book, I wondered if putting it together helped make you hopeful about the so-called American experiment, right? Because you talked to a lot of scholars about presidents in the past. You talked to some living presidents as well. And one subtext that I kind of got through the book was sort of the survival of the United States through a lot of different personalities, through a lot of different periods of history. So is that something you sort of took away from these conversations?
Sure. The United States is now the strongest military, economic, cultural, technological power in the world, something the founding fathers could never have anticipated, even though they had high hopes for the country. And we've done this even though we've had some presidents out of our 46 presidents that we've had. Some of them weren't so wonderful, and some of them were great, and some of them you kind of wonder how they got the job. But the country has risen above that. And today, the reason I call it the highest calling is it's the most important job in the world. There's no doubt that people all over the world are trying to focus on who the next president is going to be, because they know whoever the president is going to be is going to affect them. Because what the president can do as the leader of the United States can affect everybody in the world and will affect everybody in the world. So the problem with it, as you point out, is that being the president of the United States, having the highest calling, making you want to be the president of the United States, doesn't mean you're going to be successful or happy. So look what's happened to some of our presidents. John Kennedy, who inspired me to want to go into government service, was assassinated. Lyndon Johnson was driven out of office. Richard Nixon was forced out of office, had to resign. His successor, Gerald Ford, couldn't get reelected. My boss, Jimmy Carter, couldn't get reelected. Ronald Reagan almost was assassinated. George Herbert Walker Bush couldn't get reelected, and so forth. The point being that people kill themselves practically to get this job. They spend 2 years trying to get it. When they get it, and their life doesn't necessarily turn out to be better. There are some whose lives have improved after they got the job, but many of them have suffered a lot when they were president of the United States.
David, as you put this book together, what changes did you notice throughout the years in terms of the presidency, and what's the state of the presidency today?
Well, I've noticed that more and more people pay attention to every single thing the president does. Whatever he's eating, whatever he's saying, everything, enormous attention on him. And because social media is around now and covers everything, almost everybody does, but certainly the president of the United States, it's like living really in a fishbowl. Everybody sees everything you're doing, and there's no opportunity to kind of make a mistake without people knowing about it. I'd say today the presidency is in reasonably good shape in the sense that it's a respected job. Even though presidents have had lots of problems, some have not been reelected, some have been assassinated, some have had assassination attempts. It's a job where it clearly is one respected by the American people.
David, of course you didn't get to interview George Washington for many obvious reasons, but one former president you did get to talk to was former President Trump. And you asked him, and you had a back and forth with him, or an exchange with him on how he knows, I guess, or he was saying these things, how he knows more of the players in Washington. Right. I mean, if he were to win a second term, just the fact that he better understands how Washington works, does that make him more of a dangerous person in the White House or a less dangerous person?
What he said in the interview, and I've known him for a bit and I've interviewed him before, he said that he felt that when he first came in, he didn't really know all the players. Remember, he's the only person ever to have been president of the United States who did not have a government job before that. He wasn't in the military. He wasn't in the civilian part of the government. No other president had that lack of experience. So he really didn't know who the players were, and he didn't know how to trust people or not trust people or who the right people were to bring in. He said in the interview he now has a better feeling of the kind of responsibilities a cabinet officer or White House chief of staff should have. And I think he feels that he could do a better job than last time in terms of keeping people in place for quite a long time. I mean, he changed a lot of his chiefs of staff. For example, he had 4 chiefs of staff in 4 years.
I wanted to ask you as well, and I know this is something you've talked about, how we get the caliber of people like Thomas Jefferson, for example, back into government. I actually was having this conversation this week with the people who work for a nonprofit who are trying to recruit people into government, talented people into government. I mean, particularly you think about the tech sector. You know, people are going there. People are going into finance here in New York.
Right.
But government is not seen as that attractive of a job.
Well, there's a couple of reasons for it, but let me just give you one. Compensation. When people work, they want to be compensated. Right now, the U.S. government has not increased the salary of members of Congress for 20 years. 20 years. So right now, what you're getting paid as a member of Congress, what people were getting paid 20 years ago, and no cost of living increase is nothing. So you have, as a result, 75 members of Congress living in their offices because they can't afford a separate apartment in Washington, D.C. That's not a prescription for getting the best and the brightest to come into government. But I think we should compensate people more, for sure. And we should, in my view, I try to find people who just don't care about politics as the reason to go into government, people that care about the country.
If I can channel the financier side now of David Rubin's side, you wear many hats, David, but let me stick on the financier side. About 2 years ago, you came into our office and you told me that rates were going to go up for an extended period. You were right on. But now that we've gotten this first rate cut, I mean, how do you think the direction of rates will fold out? Do you see a series of rate cuts in 2025? And what does that mean to investors?
Well, there's no doubt that we're going to be cutting rates. The issue last week or so was whether it's 50 basis points or 25 basis points. And the Fed obviously went with 50 basis points, recognizing that probably if it had gone with only 25 basis points, the market was going to be so disappointed the market would have had a very big decline. I suspect there'll be at least one and probably two more 25 basis point cuts for the remainder of the year. Jay Powell used to work at my firm. I know him quite well. I think he's done a very good job in dealing with inflation over the last couple of years. I think the problem was we put $5 trillion into the economy to deal with COVID and the effects of COVID, and we didn't really have any corresponding tax increases. So it did produce inflation much higher than people thought. Now it's down to maybe 2.5% or so, and that's tolerable, not quite at 2%, but getting close to 2% target of the Fed. So I think we will see some more rate cuts, and I think that'll be good for the economy. I think the economy is in reasonably good shape. Now, remember, when you have a interest rate increases as much as we've had, you usually, when you go down and start reducing them, you do produce what's called a hard landing or a recession. Right now, there are some people predicting a recession. I don't believe we will have one. In the economic data that Carlyle has, we don't see any evidence of a recession in the near future. In fact, the U.S. economy is in such good shape that we're pulling away from the rest of the world.
So that sounds like a really good backdrop. Does that mean that corporate tax cuts can expire and the U.S. economy will be fine?
I didn't say that. I would say, for those who haven't paid attention to it, we had very large tax cuts for corporations and for individuals who are wealthy under President Trump. They expire next year. If President Trump's elected, he said he would get them extended and maybe even make them bigger than they were last time. Obviously, Kamala Harris has a different point of view. I think there will be some tax cuts, no matter who's president. I think there'll just be bigger tax cuts if President Trump is elected. But the big problem with tax cuts, big or small, is really this. What we're doing when we're cutting the taxes, small or big, is we're just increasing the deficit. We're running a $2 trillion annual deficit now out of about a $6.5 trillion budget. We have $35 trillion of debt. There is no way we're going to pay off that debt in dollars that are worth as much as the dollars we have today. It'll be paid off over many, many, many years with devalued dollars. And the dollars will be devalued in part because they won't be seen as being as worth as much as they are today. We're the only reserve currency in the world today, and we may be for another 5 or 10 years. But eventually the world's going to get tired of paying for our debt, and eventually the world will turn away from the dollar, but not right away, but sometime in the future.
While we're talking about changes that could happen under a new administration, whoever that administration is, also being in the private equity and the M&A business, I also have to ask you about regulation there. And just a brief question about Lina Khan, who folks on both sides of the business spectrum, on the political spectrum, have called for her ouster and talked about overreach. What do you think?
She was an unusual choice. For those who don't know her, she's the head of the FTC. Came to fame because she wrote an article about Amazon as a violator of the antitrust laws in the Yale Law Journal. And although relatively young, in her early 30s, she became the head of the FTC. And many people think that she is over-regulated and tried to block many acquisitions. And she's been overturned in court or blocked by court many different times. And so I would not be surprised if she wasn't there forever. But I think that she's indicated she'd like to stay. And If a Republican's elected president, I'd be very surprised if she stays. If a Democrat's elected, Kamala Harris, I can't say what's going to happen, but she is controversial. And I do think there's the concern that the business community has. Well, I can't speak for the entire business community, but there is a concern in the business community, not so much about taxes or about the economy, but about regulation. There's a perception, rightly or wrongly, that the current administration has over-regulated, particularly in the antitrust area and other regulatory regime areas. That is a bigger problem for business people than the taxes that they often would like to see cut.
David,
and so I would say I would be surprised if she's there in a few years.
David, of course, you're also you own the Baltimore Orioles. Congrats on the win. I mean, you're getting ready for the playoffs here. I mean, there's been a lot of focus the past few weeks on increasing interest by private equity in the sports space. What do you think the impact of private equity in sports will ultimately be?
Well, probably to drive up the prices, because when you have new players come in, they typically are willing to, pay more to get into the game. The reason that the NFL was allowing private equity firms to invest for the first time in teams up to 10% of each team is that there are very few people anymore who can pay the prices or the values of these teams. So if a team is worth $6 billion, as the Commanders was when it was purchased a year or so ago, there aren't that many people that can write $6 billion checks or even $3 billion checks. So you have private equity funds, they can afford to invest because they've got a fair amount of money. And the issue is whether it's a fair deal, a good deal, and the private equity people are smart enough to figure out that for themselves. But I do think you'll see values going up. And also because television contracts are getting to be more expensive. You saw the NBA entered into a new $77 billion set of contracts with various television sponsors, $77 billion. And it's expected the NFL will get a much bigger payday when it enters into a contract with its various networks over the next year or so.
I sort of listed all your accomplishments at the beginning here. You served in the Carter administration. We didn't mention that. You co-founded Carlyle. You've written a bunch of books. You host your own TV show. And yet here you are, the owner of the Baltimore Orioles. And you're probably more famous for that than for any of the other stuff. So I'm just curious how you feel about that and how this job is compared to all those other jobs.
It's surprising. I am the chairman of Carlyle and the co-founder, and I've chaired the Kennedy Center, the Smithsonian, the Library of Congress, the National Gallery of Art. Nobody's ever come up to me for a selfie for those kind of accomplishments, and nobody's asked me for my autograph. In fact, I'm so unused to signing autographs, I had to learn how to do it. And people make fun of me because I signed the date. I'm a lawyer by training, so when I sign an autograph, I give the person a date, and nobody really understands why you do that. I don't think baseball players are putting a date on their autographs.
Are you having a good time?
I'm having a good time when we win. When we lose, it's like a dagger in my heart because nothing I can do about it. I can't tell 21 and 22-year-old players how to play better, so I'm kind of rooting from the sidelines.
Costco earnings just crossing, shares down a little bit on a mixed report here. On the one hand, the company's earnings per share beat estimates at $5.29. $5.07 was the estimate. Total revenue here, $79.7 billion. The estimate there for closer to $80 billion. And U.S. comp sales, excluding the effects of gas and currency, up 6.3%. That, too, was better than estimates. So it looks like comps beat, earnings per share beat, little bit of a revenue miss.
Yeah, and of course, you pull back the chart, heading into this print, Julie, this stock has been a monster. I mean, year to date, it's almost 40%. It's about 60% over the past 12 months. And you'll hear analysts, and we've had some smart ones on the show recently talking about this name, saying, yes, it's an uncertain operating environment right now, but they'll argue this company is firing on all cylinders. They're just executing well. We just had UBS's, Michael Lasser talked about saying, listen, he does his checks. They're taking share, he says, from a lot of different players. The consumer's looking for value. They're consolidating trips and spend. So Michael says if that's what they're doing, Costco would look to be a good beneficiary of those trends.
Yeah, I also thought it was interesting looking at the statement here, the growth that the company is seeing outside of the U.S. Now, as I mentioned, that adjusted comparable sales increase was 6.3%. In Canada, it was 7.9%. And in other international locations, it was 9.3%. They have locations in Mexico, Japan, the UK, Korea, Australia. Their e-commerce numbers also up big, 19.5%, which is an acceleration. So that was interesting as well because, maybe people don't think of Costco as much from the e-commerce perspective. It's really about that in-person experience of going to a Costco.
Yeah. Andrew Lipton, my dad, know what he thinks of Costco? Steaks.
Steaks.
Loads up on Costco steaks.
All
Big
right.
fan. At least initially here, we see the shares edging lower about 0.8%. Time now for What to Watch Friday, September 27th, sponsored by Tasty Trade. Starting off on the economy, we're going to be getting new monthly PCE data. That's personal consumption expenditures tomorrow morning. Economists forecasting the Fed's preferred inflation gauge to slow in August to 0.1% for total PCE, while core PCE holds steady at 0.2%. New numbers will be one of the first since the Fed's historic 50 basis point cut last week, and giving us more insight into the state of consumer spending.
And taking a closer look at the Fed, we'll have a lot of commentary. More from Fed Governor Michelle Bowman is going to take place in the afternoon. She cast a lone dissenting vote on the Fed's decision to cut interest rates by 50 basis points last week. Bowman saying this week about that half-point cut that it could be interpreted as a premature declaration of victory.
And the final consumer sentiment reading for September coming out in the morning. That number expected to go tick up slightly to 69.4, giving us a measure about how optimistic consumers do feel about their finances.
And we'll also be keeping an eye on Hurricane Helene. The storm upgraded to Category 3 ahead of its expected landfall on Thursday night. The storm currently tracking toward the Florida Panhandle. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. There are some of the trends we're going to be diving into here. It is a record day on Wall Street. The S&P 500 closing at a new high after a slate of strong economic data, and it comes ahead of a key inflation reading tomorrow. We're diving into the key themes from the trading day, plus a new kind of Magnificent Seven. Instead of the likes of Nvidia and Amazon, we're looking at the companies that could be the next key market drivers, and they are still private. We'll give you a list and insight into how you could invest in the private market. And turmoil brewing at OpenAI, the company reportedly restructuring, including conversion to become a for-profit company as it faces more personnel changes. While we've all been watching many of the Mag 7 stocks surge over the past year or so, new data from Forge Global says a Mag 7 made up of private companies like SpaceX, OpenAI, and Fanatics is doing even better. So why exactly are these private companies outperforming their public counterparts? Joining us now to talk about all this is Kelly Rodriguez, Forge Global CEO. Kelly, great to see you on set.
Great to see you, Josh.
Let's start, for many viewers who aren't familiar, what you guys operate there, a secondary market, right, where insiders can buy and sell shares of private companies. Big picture, talk to me about, the bigger themes and trends you're saying play out right now.
Well, it is a global marketplace, but one of the bigger themes is a lot of people who aren't insiders are trying to get into it. The private market has been one of the highest performing asset classes for over a decade. And big companies, such as the ones covered in the Mag 7, private Mag 7, are staying private longer and longer, and they're getting bigger, and people want access to those names.
We mentioned some of it there on the screen, private Mag 7, Stripe, OpenAI, SpaceX. I'm curious, how do, you mentioned there, they are staying private for longer. What are the reasons for that, Kelly?
Access to capital, primarily. The companies that you're looking at here in the private Mag 7, they're the biggest, they're the most resilient, and now we can start to check their price performance. And when you look at that, this group of companies makes up the leading group. Probably about 25% of the private market valuation is in these 7 companies.
How did you screen who would make the list? What were the metrics?
Well, we now have data. In the last 5 years, we've amassed enough data to look at relative pricing so we can see what people are trying to buy and sell it for. And because we've got the actual price marks, we can look at how that price moves over time. That combined with what the companies have disclosed about their performance, these are the biggest and the best performers.
Any line of sight on how do valuations then look for some of these names?
Oh, sure. SpaceX was valued at $212 billion today. OpenAI made a big announcement. And all of these companies, I think you heard rumors today that, and this company, Cerebras, is not in the Mag 7, but there's rumored that they're going to go out today, and we see their valuation at about $7 to $8 billion.
I get that you can raise a lot of money, certain private companies can, but at the same time, wouldn't you think, Kelly, you look around, I mean, Jay Powell just told us the economy's okay, he's easing. I mean, the market hitting records. Isn't it a good time to go public?
I think you're just now starting to see the market open up. Those announcements today, including Chime, were big. We thought the market would start to open up later this year. I think the rate cuts came a little later than some people thought. And so I'm optimistic about the IPO market in 25. And I think oh yes.
Yeah.
Oh yes.
What are the reasons for that, Kelly?
I think, as you point out, I think there's a lot of pent-up liquidity demand in private companies. These companies are private for 12, 15 years. The investors and the funds that back them, they want liquidity at some point in time.
They've got life expenses like everybody else, is your point. Do you think some CEOs, is your sense, is it possibly election plays a role in there? Some founders and CEOs are thinking, you know what, I'm going to wait to see how things shake out. Is that a potential variable or not really?
Absolutely. I believe the election is a cause for uncertainty. And in an uncertain environment, people will wait. So my view is because it's an election year, and even though the rates are coming down, people are going to see how this election turns out.
All right, we'll see. Kelly, thank you so much for joining us today. Appreciate it.
Thank you, Josh.
Another record close for the S&P 500. More soft landing economic data, and China stocks rally again. Here with the trading day takeaways, Yahoo Finance's very own Josh Schaefer. Josh.
Hey Josh, yeah, our 42nd record close for the S&P 500 this year. So we got to start right there, and I want to take a look at the market action that we had for the day. I'm going to flip over to the sectors quick just to see what was leading us today. It was materials and also tech were kind of the clear outperformers. But Josh, we were talking earlier this week, remember we said not a ton of economic data this week that felt like it could really move the needle as long as it came in line, and B of A had sort of predicted, okay, maybe stocks just kind of drift higher. Take a look at our 5-day. That's what we've had, right? We've just kind of had a lot of things that haven't rattled markets. There hasn't been a ton to digest, and we've just seen a slow drift higher. And that's all, of course, leading into that PCE print tomorrow, where there are expectations for inflation to come in soft again. So if that comes in different, then maybe we start to see more choppy action, but it's kind of been a little bit smooth and slow sailing for the markets.
I guess if you believe, as rare as it is, that Jay Powell stuck the soft landing, maybe some of the data you saw today was sort of ammo in that argument.
The data sort of fits that, right? So that's our second takeaway today. We had GDP out this morning. Remember, this is GDP for the second quarter. This ended in June. So really the only disappointment would have been if this number, 3%, which is what we were already looking at, came in lower. It actually came in line, and you had revisions higher for past. So it really wasn't the kind of thing that was going to move markets. And really what I thought was actually most interesting economic today was jobless claims. Jobless claims came in at a 4-month low. I was just speaking to a couple economists about the jobs report that's coming up next week, overall labor market. Josh, every economist I talk to right now is talking about jobless claims because they're talking about layoffs. This seems like the key right now for the labor market would be that we don't get this. That we don't get jobless claims ticking back up, because if people are not getting laid off, then we're in a labor market where things are just kind of staying stagnant, and that's okay. If things stay stagnant, that's okay. If it starts to pick back up, that seems to be the big thing people are watching.
I saw the economist Stephen Stanley was talking about this data point this morning, his clients, and sort of, I guess his big takeaway is the pace of layoffs, he said, broadly, it's still just historically low. I mean, it seemed to be his takeaway was that maybe the labor market really isn't as weak as some have been fearing.
This chart would move significantly higher on most historical standards if we were going to go into a recession. So not only would it have to start picking up from the 218 that we see today, it would have to pick up for weeks and weeks and maybe even months. It's a leading indicator, but until it moves too much, right now it's kind of telling us steady as it goes, which is probably why stocks are doing pretty well here. One area of the market, Josh, I wanted to hit, these China stocks just keep ripping. It has been an unbelievable story to watch this week. I'm going to flip over and get us KWEB here, that China internet ETF. If I can get to the leaders, and here we are. Look at it, up 11.5% today. We zoom out over the 4-day to look at the full week. It's up 22%. I mean, this is just a crazy rally going on in these stocks. I know we talked about this the other day, and it seems like the large story here is still, what does it actually mean for the economy and how does it feed through in China? I thought Steve Sosnick, who was on with us yesterday from Interactive Brokers, made a good point. If you're an investor in the US, you should be rooting for this. Remember how tied the US economy is to China. If the Chinese economy is to recover more, that's an overall positive, not just for things that are related to China, but just the market as a whole in the economy.
You wonder, I mean, it's been such rapid fire actions and measures out of Beijing. You do wonder what are they seeing in their economy? And obviously they're seeing malaise. To your point, does it work? And then the other issue we've been talking about the show on today is some raising the question, if it did work, what would that mean for the disinflation storyline that a lot of central bankers have been touting? I mean, would that kind of throw that off? Would that have to be rethought?
And then the final thing to look at here, this is something we talked about the other day, but I think it's important to keep pointing out as we talk about this rally. We've seen it before. So you kind of got to see it to believe it for a little bit longer, and I think that's what I've seen some strategists continue to say, even after today's rally.
We heard that today on the show. There's some strategists urging, I think, caution.
You see something like this, and you think short squeeze, right? Part of this is a little bit of a short squeeze, and it's just things melting up and shooting up instantly. Where does it settle next week as people start to really look into the market and decide what they like? That will be interesting to see. Right now, you're just seeing it pop. How does it play out over the next couple weeks? I think is going to be the trend.
We'll have you back to talk about it.
Can't wait.
All right, don't go anywhere. We're asking for a trend right on the other side. Disruption at one of the key disruptors in artificial intelligence, OpenAI. 3 executives leaving the company as it now looks to become a for-profit company, and it comes as the company reportedly nears a $150 billion valuation as part of its latest fundraising round. Joining me now is John Keaton, Torch Capital founder and managing partner. John, always good to see you.
Great to see you.
Let's start this. OpenAI making a lot of news this week. Sam Altman, some key executives of his are leaving. We got these reports that corporate structure could be changing. I had Elon Musk going after Sam Altman on X. Walk me through it. What do you make of all this?
Well, I think as the competition's gotten more severe, OpenAI has shown a lot of success. They've developed product after product, released successfully, and I think they're just trying to equalize the playing field. I think they probably felt being a nonprofit was a bit of a weight on them, and so they're restructuring to be more competitive with Anthropic or XAI. I believe that what I've read is the not-for-profit will now have a piece, but the main governance will be for-profit, with Sam having proper equity and lining up as a normal corporation.
You know, Altman is listen, I've interviewed him before. He's a smart, very ambitious guy. I was talking to a friend of mine, like yourself, John, smart tech investor. He told me I wouldn't put a dime into OpenAI. And not to say he has respect for Altman and what they've accomplished here. I think his point was he didn't understand what their competitive moat was, competitive advantage. He sees big tech moving in, kind of narrowing the gap. I'm not asking you to be as dramatic as that, not put a dime in. But walk me through it. I mean, do you think there's any validity to that argument about their competitive moats and advantages?
I think the biggest issue, it's still really early. This is new technology. If we think back to 1999 or 2000 in search engines, massive technology, incredible capabilities, but the first winners, Netscape and Alta Vista, I think there's one called Archie, you know, they were valued and grew as the category winners, but in the end, Google won as the 7th, 8th, or 9th, I don't remember, search engine. So we're just still early, and so it's very hard to see what are the competitive advantages and what are going to be the key things that make the winners. And so from that perspective, OpenAI is doing a phenomenal job, but it still remains to be seen across the board. And with Microsoft and Google having other bases of operations that they can play from, it's definitely could potentially be a challenge.
Let me ask you, John, switching gears a bit. So as a venture investor, are you as excited about AI like as you were 6 months ago, 12 months ago?
So yes and no. Probably more excited. The capabilities and the adoption is through the roof, and it's going to absolutely be a moment, much like in the 2010s when we saw mobile, social, cloud, and location converge, and that created the DoorDashes and Ubers and Airbnbs. So yes, the potential is tremendous. I'm more excited than ever. In terms of where it's being hashed out now with these huge companies, infrastructure, very early in the curve, like I just mentioned, we're trying to stay out of that, and we're really looking for the commercial application layers, early stage investors. And I still think it's early, and on the consumer side, it hasn't been proven out yet, but it will be. But right now, we're seeing it with the efficiency in our startups already.
So you see it playing out in your own portfolio, the founders, entrepreneurs using it?
Absolutely,
yeah.
And we're seeing it. I mean, engineering teams, they can do more with less people. Marketing teams already can do more with less people. And again, we're just early. It's going to get better and better and better. And what I think that means is a founder with a great idea can go a lot farther off a small amount of money and maybe even get to profitability before they start needing to raise later stage rounds, which means getting early is more important. And at Torch Capital, luckily that's what we do. But we're already starting to see the effects that I think will amplify over time. And the consumer side is starting to happen. We just had one of our portfolio companies called Arcade that just launched today and was in the press. They're creating the first AI-driven product creation platform. So think Etsy with AI, and anyone can create a product and have it produced with a few clicks and sent to them. And so that's the sort of game-shifting capabilities that AI is going to create on the consumer side, but we're still very early. And Arcade, I think, is one of the first leaders in the space.
There's something I have to go, but very quickly, John, I had a guest on the show today, enthusiastic about the IPO market in 2025. Do you share that enthusiasm?
No. Well, when it comes to tech companies, no. In the private sector, I think interest rates are great. It's positive. The markets are up, but these companies have raised a lot of money. They don't want to be distracted by an IPO, and they're building and they're growing. I think they're going to sit out another year, maybe 2, until the markets are wide open. Why create friction when they don't need to? I know there's pressure for liquidity from their investors, but if the companies are doing well, I think the companies have the control, and they're going to say we want to stay private, whether it's Stripe or some of the other ones that people are talking about, Databricks, et cetera.
Always great to have you on the show. Thank you.
Thanks.
Appreciate it. All right, for our chart of the day, we're looking at Bain & Company's 2024 technology report, and specifically AI spending. Yahoo Finance's Julie Hyman join me now with a closer look. Julie.
Yeah, this is a good complement to the conversation you were just having with John Keaton. And one of the interesting things, it's not the chart of the day, but one of the interesting things in that Bain report was the idea that the amount that the so-called hyperscalers are spending, the Microsofts and Amazons of the world, actually dwarfs the amount of VC investment that is going into AI companies. The R&D from the big companies is much bigger. So I thought that was an interesting stat as well. But what's also interesting is that across the company size spectrum, we are seeing an increase in spending on AI. So let me walk you through this chart of the day. The biggest pie here is companies that were spending under $1 million on generative AI last year in 2023. So and most of those are small companies, right? The next biggest piece of the pie is $1 to $5 million, all the way up to over $100 million, which is this little purple slice of the pie. Well, you fast forward a year here to 2024, and you see that all the parts of the pie are growing, but particularly small company spending, but also the largest part. In other words, spending is growing up across the board. And as we've been talking about, the top line of that Bain & Company report is that through 2027, we could see as much as a 55% annual increase in this spending on generative AI to reach $990 billion by that point in time. We talked to David Crawford at Bain, one of the authors of the report earlier, and he talked more about this spectrum of spending.
But yeah, we were astonished to see the rate at which, for example, in the report we published, the number of companies is spending over $100 million in their annual IT budget alone on AI. And with large enterprises, that's doubled. But it's not confined specifically to large enterprises. Smaller enterprises, whatever level they are spending at, has actually doubled as well. And so you can pick any kind of spend or IT budget threshold, and they're almost uniformly increasing their spend.
Small, large, it doesn't matter. What are they spending on? Well, the report says it's things like code generation, documentation, refactoring, debugging, testing, and maintenance as well. And it also said some developer organizations are already saving 15 to 40% on code generation and documentation. So just some examples of not just the size, but all the different stuff that we're starting to see these companies spend on and then save as a result of, which just goes back to the conversation you were having with John Keaton.
That's it. Julie, thank you so much. Appreciate it. And coming up, Costco shares lower following their latest earnings as investors are giving the report a big doom. We're going to dive into the latest on the other side when Asking for a Trend returns. A Trump media shareholder is dumping millions of shares in the company. According to a regulatory filing, United Atlantic Ventures LLC sold 7.5 million shares. UAV, whose managing member is former Apprentice contestant Andrew Latinsky, received more than 7.5 million shares in late March. Remember, that's when Trump Media went public after completing its merger with the blank check company Digital World Acquisition Corp. That represented 5.5% of the then outstanding shares in the company, filing saying that as of the date of this filing, United Atlantic Ventures LLC owns 100 shares. Costco earnings just out. It was a mixed bag, beating on earnings but missing on revenue. And joining us now is Yahoo Finance's Brooke DePalma. Brooke.
That's a mixed bag here. Costco earnings per share beating estimates by 22 cents, but revenue coming in lighter than expected. But I do want to take a closer look at one key metric that Wall Street is watching very closely, and that's membership fee revenue, membership fee income. It came in slightly below expectations for the quarter, coming in at $1.51 billion compared to what expectations were of $1.54 billion per Bloomberg consensus data. And they're really following this because at the end of the quarter, that's when Costco planned to hike its membership fee for members. $5 more for Gold Star membership, $10 more for executive memberships. And Yahoo Finance asked UBS analyst Mike Lasser about this and how these new membership fee hikes will likely impact that key stat and some benefits that consumers can see.
Historically, Costco has experienced very stable and strong retention trends in the 90% range. We expect that to continue, even if it does ease off ever so slightly. And number two, how is it using this additional pool of profits that it's going to be able to accrue to increase the value proposition to its consumers?
Now, Lasser went on to say that he thinks Costco may have then, before they anticipate a benefit of those lower fees, already lowered prices. And this is key, Josh. Costco, known to be that wholesale retailer, they need to continue to have a leg up against Walmart, Sam's Club, or against BJ's, and also Walmart and Target in general, which is introducing more and more value deals.
What did we learn, Brooke, about Costco's e-commerce sales and maybe what gold had to do with it?
Yeah, gold, a hot topic this week on Wall Street and in Main Street as Costco customers are actually going to Costco's e-commerce website to buy gold bars. So currently gold bars are on sale on Costco's website for $2,679.99. Now, e-commerce stood out in this report. It jumped 19.5%. That was slightly lower than Wall Street's expectations of 19.6%. But gold bars continue to drive demand to Costco's website. We know that this is something that they've pointed out in recent reports. And gold also hitting an all-time high today, or gold futures rather, hitting an all-time high at $2,700 or $27.0870 there during today's trading session. But gold bars continue to drive e-commerce sales for Costco. We also know that that's much higher than the same store sales growth Costco's seeing in general of 6.9%. And so e-commerce, especially with these new executives at Costco, really, really exciting for the street as well.
Yeah, I'm just trying to see what the stock's doing after hours here. Maybe not 1%, but you pull back the chart, the stock has been a monster. I mean, it's up about 40% this year heading into the print, right? It was about 60% over the past 12 months. We talked to analysts, Brooke, and what they'll say is it is an uneven operating environment out there, but this is a company that just continues to execute. When consumers are looking for value, they're looking to consolidate trips and spend. If those are big trends, you would think Costco's pretty well positioned.
Yeah, and keep in mind, this is Costco's Q4 report. And so really this is the beginning of a new fiscal year for Costco. And investors are really looking to see how they're gaining market share, how they continue to do well in general grocery, what they call sun food items or something like that. But then also, too, how they continue to do well in merchandise. We know that Costco comes in with a lot of dupes, a lot of different items that really gets those members, one, willing to pay perhaps this increased membership fee hike, but then also willing to renew it when it comes time.
Yep. Brooke, thank you so much. Appreciate it. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.